He talks about the overvaluation of the dollar due to its uses as a global reserve currency, how the cost of that is basically undermining our industrial base, making us less competitive in manufacturing, and how some of those imbalances where the downside of that system have surpassed the benefits of the system for America broadly. And so he kind of analyzes different ways that this might be addressed, and then also goes over some of the risks of addressing them. Like it's not treated as like a surefire solution, but like if you were to go about this, what are the ways we could do it? What are our options? And they include things like, starting with some mild tariffs, which kind of is like if you treat it like a carrot and a stick, that's the stick. And then when there's kind of multiple mild tariffs on that are somewhat disruptive, that they could do some sort of currency accord, a series of trade deals that are in the United States' favor, that could then bring down some of those tariffs and start to maybe balance out trade somewhat. Then he faces the issue of, okay, well, what's next? What's after that? Because there's still the issue that if you want the dollar to be the global reserve currency, you have to supply the world with dollars. And so he focuses on, well, one, you could give up some of the reserve currency status. So it's not a Boolean thing. It's not like you either have global reserve currency status or don't. It's really a percentage thing. And so one thing I've been pointing out for years is that you can have a multipolar world where Chinese currency is kind of the main currency over in East Asia. The United States' dollar is the currency in our hemisphere and other parts of the world, and Europe's is kind of their part of the world and their biggest trade partners in periphery. So you can have kind of three currency blocks of different sizes. You can have an elevation of neutral reserve assets. So he specifically calls out that this plan would be good for gold and cryptocurrencies, which we mean Bitcoin. He uses the phrase cryptocurrencies. And so over time, funding currencies that are cross-border can shift a little bit. There can be different incentives to maybe have the world shove less of its like asset flows into U.S. assets and instead buy things like gold or Bitcoin or potentially some other assets from other countries and kind of diversify this to some extent. And then there's also various mitigants, because if you weaken the dollar, you risk higher inflation, you risk higher bond yields at a time when fiscal deficits and U.S. interest expense are very high. So he talks about, as part of trade negotiations, terming out the debt, convincing countries like China or Japan to increase the duration of their treasuries and basically agree to get like their reserve assets inflated away. And so I think the plan overall, it's articulately described.